We are breaking down subsidiary ledgers today. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that is my sidekick, Terrence. We are here to put the fun in accounting fundamentals. So when we talk about our financial statements, we're talking about a summarizing of the activity in our different accounts and the balances in those accounts, and we're bringing those into our financial statements. But some accounts require us to keep more details, specific details of transactions, particularly customer balances and vendor balances. So we sell to our customers, we buy from our vendors. And we need to know exactly who we sold to or who we bought from and how much money is involved in each one of those transactions. Have we paid the bill yet? Have we collected the money from the customer yet? This is why we have subsidiary ledgers. Subsidiary ledgers are the details behind the balances in accounts like accounts receivable or accounts payable. So each one of our customers or vendors is going to have an account in that subsidiary ledger. So for our customers, each customer has their own account. And in the olden days, we used to keep track of that on these little green ledger cards where each customer would have their own ledger card, and we would go on there and enter that we sent them an invoice for this much and that they paid this much, and we would keep a track of their balance. Those balances were then totaled up, and that became our accounts receivable balance for that month. Now, in financial accounting or principles of accounting, when we sell to a customer, we create a journal entry that debits accounts receivable and credits our revenue account. In real world accounting, where we use accounting software to do these things, we would create an invoice, and that would increase accounts receivable and increase our revenue account. So it's doing it for us, but behind the scenes. So this would increase our customer's balance. We can then go and look at our customer's balance and see that that invoice is in there. Then when our customer pays us, we're going to reduce their balance. So in financial accounting, we would do a debit to cash and a credit to accounts receivable to reduce the amount that they owe us. In our accounting software, we would receive a payment and we would apply it to that customer's account. And then we do that for all of our customers. And then we take all of our customers' balances, we add them together, and that becomes our accounts receivable balance. Now, for our vendors, the same thing's going to happen on the accounts payable side. We want to track all of those details about what we bought from that, how much we spent to get whatever the merchandise is that we're buying, and then we want to know whether we have paid that bill yet. So we don't have to guess or wonder or think, or it's all right there in our accounting records. Now, in financial accounting class, when we purchase something from a vendor, we are going to debit merchandise inventory or some expense, and we're going to credit accounts payable to show that we haven't paid for this yet. In real world accounting, in our accounting software, we're going to enter a bill, and that bill is going to capture those details. It's going to increase the amount that we owe to that particular vendor, and it's going to show whatever it is that we purchased from that vendor, either as an expense or as an asset like inventory. And then when we pay that vendor, we're going to pay a bill, and that is going to decrease the amount that we owe them. It's going to debit accounts payable, as we would have done in financial accounting, and it's going to credit cash. And it's going to reduce the balance that we owe to that particular vendor. At the end of the month, all of those vendors' balances added together gives us our accounts payable balance for our financial statements. Now, when we use our accounting software to track our customers and our vendors' accounts, we don't really think about what's going on in terms of a subsidiary ledger, all of those details behind the scene. We're not thinking about, oh, we've got to update every single customer card and every single vendor card every time a transaction happens, because all of this is happening behind the scenes in our accounting software. So in our financial accounting class, or principles of accounting class, we learn the concept of subsidiary ledgers by using journal entries and posting to customer or vendor accounts. And then in the real world, we apply that concept using our accounting software. But it's always good to know what's happening behind the scenes, because then you're able to do it correctly with good understanding like a boss. Until next time, stay balanced, my friends.